Professional investors collectively manage trillions of dollars. They make many brilliant decisions, and yet still make some of the mistakes we make. Let's learn from both. I'll explain several scientific studies of millions of their decisions, and also the example of legendary investor Warren Buffett. By the end of the video, you have a set of tools that can help you make better investment decisions. First, professionals can spot stocks that are worth more than they cost. For example, Warren Buffett bought $5 billion in Goldman Sachs stocks during the 2008 financial crisis and gained more than 70% 3 years later. More generally, mutual fund managers often make large buys when others are selling the stock heavily. A study of 1,400 US mutual funds over 23 years showed that such purchases outperformed their benchmarks by 2.8% in the year that follows. They can also spot stocks that are worth less than they cost. Stocks which they sell heavily when others are buying heavily underperform their benchmarks by 0.7%. How do they know which stocks to trade? One key aspect may be the ability to forecast earnings. Another study on the universe of US mutual funds found that trades by mutual funds can predict quarterly earnings per share surprises of the underlying stocks. In 22 of the 22 years in their study, stocks that funds are buying have higher EPS surprises than stocks that funds are selling. Indeed, subsequent earnings announcements returns for weight increasing stocks are on average 0.38% higher than those on its weight decreasing stocks. Moreover, professionals invest more in stocks they are more familiar with. Mutual fund managers are often connected with corporate board members through shared education networks. Indeed, many mutual fund managers and portfolio managers were often classmates at top universities such as Harvard. Portfolio managers place larger bets on connected firms and perform significantly better on these holdings relative to non-connected firms, by up to 7.8% per year. Portfolio managers appear to be gaining an informational advantage through their educational networks, as the increased returns are concentrated around corporate news announcements. What can we learn from this video up to this point? Before buying a stock, it's worthwhile to ask ourselves a number of questions. How much do I know about this company? Do I think it will outperform my portfolio? And if so, why? However, professionals make mistakes too. One key mistake is that they pay less attention to selling decisions than buying decisions. 4 researchers studied 800 highly skilled portfolio managers. And by highly skilled, I mean that their funds outperformed the benchmark by 2.6 percentage points a year on average for more than 5 years, even though their funds are no riskier. Their buying decisions outperform buying a stock randomly selected from their portfolio by 116 basis points. However, their selling decisions don't. In fact, their selling decisions underperform selling a randomly selected stock in their portfolio by 80 basis points over the next year. While they carefully choose which stocks to buy, their selling decisions are more motivated by the need to obtain cash. Thus, they tend to use heuristics when selling stocks. They are more likely to sell stocks that have performed extremely poorly or extremely well recently. Even Warren Buffett is prone to selling outliers. It's impossible to pinpoint mistakes even with the benefit of hindsight, but his selling of airline stocks when they tanked during the pandemic has been criticized as leaving billions of dollars on the table. Hence, before you sell a stock, ask yourself, have I thought enough about this decision? Am I being too influenced by the stock's recent performance? What other stocks should I consider selling? Another mistake that even professional investors make is being too cautious about losing money in the short term. You see, the US stock market returns 7% more on average than relatively risk-free assets like government bonds. Yet professional investors still buy a non-negligible amount of risk-free assets. Even Warren Buffett holds tens of billions of dollars in cash at any point in time and defends his reasoning as follows.
We have an aversion to having 1 million plus shareholders, maybe as many as 2 million, and having a lot of them ever really lose money if they're willing to stay with us for a while.
Economists have calculated that holding significant amounts of cash for long periods of time implies implausibly high levels of risk aversion. People are behaving as if they prefer a certain payoff of $51,000 to a 50-50 bet paying either $50,000 or $100,000. In 2019, a shareholder asked Warren Buffett, "Why didn't you invest Berkshire's cash reserves into an index fund?" that would have generated $43 billion more over the past 15 years? Buffett's response started as follows.
That's a perfectly decent question, and I wouldn't quarrel with the numbers. And I would say that is an alternative, for example, that my successor may wish to employ, because on balance I would rather own an index fund than carry treasury bills.
However, there are ways to reduce the fear of a short-term loss. In an experimental test of a new trading platform, some traders were provided with price information every 4 hours, while others were provided with price information every second. The traders who were provided with price information every 4 hours invested 33% more in risky assets and had profits that were 53% higher. In other words, providing less information decreased traders' fears of making short-term losses, enabling them to reinvest more in risky assets. Hence, when we decide to hold cash, we should ask ourselves if we are too concerned about short-term stock market risks, and if so, examine ways to overcome it. For example, we can allow ourselves to only check prices infrequently using site blockers if necessary. Thanks for watching this video. Remember to like and subscribe for more videos.